Okay, let's get right into it. Today, we are tackling a really tough but super important question. How much house can you actually afford in 2026? Because let's be honest, the whole financial world has shifted, and the old rules just don't apply anymore. So that's the real question, right? Not what a bank will approve you for, but what you can really, truly afford to live with month after month. There's often this huge kind of scary gap between what a bank says you can borrow and what your personal budget can actually handle. And that's exactly what we're going to break down today. And look, there's no sugarcoating it. The math has gotten a lot tougher. We're in a whole new world of, 6% mortgage rates. The median home price is hovering around $400,000. This new reality completely changes the affordability equation for pretty much everyone. So, to figure all this out, we first have to decode the rules of the game. We need to understand what the lenders and the financial pros are even looking at. Let's start with the big one: what the banks use to decide if you even qualify for a loan. It's interesting because lenders and personal finance experts look at this from two totally different angles. Banks, they live by this thing called the 28-36 rule, and that's all based on your gross income, your salary before taxes. But a much safer, more personal rule of thumb is to keep your housing costs under 30% of your net pay, your actual take-home cash. One rule tells you how much you can borrow, the other tells you how much you can comfortably live with. So let's break down that bank rule really quick. The 28 just means they want your total housing payment, that's your mortgage, your taxes, your insurance, the whole shebang, to be less than 28% of your gross monthly income. The 36 means that housing payment plus all your other debts, think car payments, student loans, needs to stay under 36%. And this brings us to probably the most important point of this whole thing. Approved does not mean affordable. A lender's job isn't to make sure you can still save for retirement or, take a vacation once in a while. Their one and only job is to make sure they get paid back. So just because they give you the green light, it does not mean that house is actually a good financial fit for your life. Oh, and one more little gotcha to watch out for: PMI. If your down payment is less than 20%, you're probably going to get hit with this. It's called private mortgage insurance, and it's basically an extra fee you pay every month that gives you absolutely zero benefit. It's just there to protect the lender in case you default. So it's just more money out of your pocket. All right, enough with the theory. Let's run some actual numbers. We're going to look at a few different home prices. And for our examples, we'll assume a 20% down payment so we can avoid that PMI and a 6% mortgage rate. First up, let's look at a $250,000 house. So right off the bat, the first major hurdle is the down payment. For a $250,000 home, you're going to need $50,000 in cash just to get in the door. And that in itself is a pretty big mountain to climb. Okay, so you've got your 50 grand down. That means you're borrowing the other 200,000. At a 6% interest rate, and once you factor in property taxes and homeowners insurance, you're looking at a total monthly payment of right around $1,600. So, who can afford that? Well, this slide shows that gap perfectly. According to the bank's 28% rule, you'd need a gross salary of about $68,500 a year. But if you want to live comfortably, using our much safer 30% of net income rule, you'd actually need a salary closer to $85,000. That is a massive difference in real life. Okay, let's double it. What about a $500,000 home, which is right around the national median price these days? Well, that first hurdle just got way, way higher. We're now talking about a $100,000 cash down payment. And when you think about the fact that the median American savings account has something like $8,000 in it, this is a huge, huge barrier for most people. And after you've somehow scraped together that massive down payment, your all-in monthly cost for this house is going to be somewhere in the neighborhood of $3,000 every single month. That's a serious financial commitment. And what does it take to cover that? Well, the bank would probably say yes to a household income of around $128,000. But to actually be comfortable and to keep that payment under 30% of your take-home pay, your household really needs to be earning closer to $160,000. At this price point, we are definitely talking about a dual-income household for almost everybody. All right, time to enter what used to be aspirational territory, the $1 million house. The crazy thing is, for a lot of people, especially if you live on the coasts, think San Diego, Seattle, New York, $1 million doesn't get you a mansion anymore. It gets you a pretty standard house. So for a $1 million home, you need an eye-watering $200,000 in cash for the down payment. After that, your monthly payment balloons to about $6,000 a month. So to afford that, the bank might sign off if you make $257,000 a year. But to be truly comfortable, your household needs to be pulling in closer to $320,000. So who actually makes that kind of money? This chart really puts it into perspective. To comfortably afford a $1 million home, you have to be in the top 5% of all U.S. households. We are now talking about a tiny, tiny fraction of the population. And just for fun, let's look at a $2 million home. The numbers here are just astronomical. You need $400,000 in cash just for the down payment. And to comfortably handle the monthly payments, which are around $12,000, your household would need to bring in about $700,000 a year. And how exclusive is that club? This is top 2% territory. We're talking about households where you have 2 doctors or 2 lawyers or maybe a senior VP at a big tech company. It's a level of income that very, very few people ever reach. Okay, so after all that kind of intimidating math, I want to pivot to the most important part of all of this, which is how you can take back control. It's all about finding your personal bottom line. So here it is, a quick summary of the brutal math we just walked through. To comfortably afford these homes, you're looking at salaries from $85,000 all the way up to $700,000 a year. It really just hammers home the massive disconnect between what people earn and what houses cost in 2026. If you only remember one thing from our time together, please let it be this. Do not let a bank, an institution that has its own best interests at heart, not yours, dictate the single biggest financial decision of your entire life. You have to be the one in the driver's seat. And here's how you do it. It's actually a pretty simple 3-step process. Step 1, figure out exactly how much cash hits your bank account every month. That's your net pay. Step 2, track where every single dollar is actually going. You got to know your spending. And then step 3, based on that reality, you set a housing budget that lets you breathe, that lets you save, and lets you sleep at night. So now you've got the tools. You have the framework to run these numbers for yourself. So the last question to ask isn't just about what you can afford right now, but about what role you want a home to play in your long-term financial story. What does home really mean for your future?